Well, hi everyone. Welcome to the third Thursday Themes webinar series. I'm Mark Wade. I'm one of the team members here at CAZ. Joining me today is Dan Schmitz with Stone Peak Infrastructure Group. Really excited to get into an interesting topic and something that's very top of mind for a lot of investors in today's world, given all the news headlines and activity that's going on in the infrastructure space and how it's spending. So Dan, thank you so much for joining us today.
Appreciate it, Mark. Very happy to be here with you guys.
Yep. So your firm and the strategy you guys are invested in, I'm sure many of the investors and folks tuning into this call are familiar with you, but some might not be. So give us an overview of your firm, what you guys are investing in, and what themes within your space are you most focused on today?
Absolutely, very happy to. Look, Stone Peak today is the largest independent infrastructure and real assets private markets manager globally. We've been a leader and a pioneer in the space at Stone Peak for the last 13 years, and many of our partners and principals within the business have been at it for 20 to 30 years. Sitting here today, we have 60 billion of assets under management across 7 different strategies. Those are primarily infrastructure private equity strategies. Some are regionally focused. So, for instance, North America, we have a strategy focused on Asia Pacific. Some are sector focused. Energy transition and renewables, obviously a incredibly hot space today with a lot going on. We have a strategy dedicated to that sector. But we also invest across infrastructure credit and infrastructure adjacent real estate as well. And so have a pretty complementary and robust platform across the infrastructure and real asset space and across the capital structure as well. We really believe that allows us today to be incredibly relevant to both our investors, providing different elements within their portfolio that can be highly complementary within obviously one manager, but even more importantly, highly relevant to the market in a way that many other managers in the space are not able to be. And candidly, 5, 6, 7 years ago, we weren't able to be either. We can now really look across the global infrastructure and real asset space and say, where are the most interesting thematics? Where's the most need for capital and expertise? And how do we look to solve that problem for that counterparty, that owner, strategic developer of assets, a JV partner, versus saying, here's the one thing that we can do. Does that fit your need? And we think that allows us to be an incredibly active and relevant player in the market and pick the absolute best opportunities at any given point in time. And the last point I'll make about Stone Peak as a platform, as I noted, the largest independent player in the space, and we think that's really incredibly important for the culture of the firm and the alignment with our investment partners and the portfolio companies that we oversee and operate. We're a lean, hungry team. We're not part of a broader financial supermarket model, but we have the resources of a 60 billion AUM firm and 250 team members, all dedicated to and specialized in infrastructure and real assets. And we think that's a particularly powerful combination.
That's excellent. Thank you for that background. Maybe share some 1, 2, or 3 of the themes within those various strategies that Stone Peak is most excited about in today's market.
Yeah. So, Mark, I think the theme I'm wanted to talk most about today is actually more geographically oriented, and that's the opportunity set across the North American infrastructure market broadly. And really, we operate primarily focused on 3 different sectors. And I'll talk a little bit more about this as we go along, but it's pretty rare that there is a what I call kind of a massive mega trend tailwind across each of those at the same time. Typically, we're kind of tactically looking at where to focus, where the best risk reward is within a pocket of the market and sidestepping others that might be a little bit more challenged at a point in time. But across energy and energy transition, digital and communications, and transport and logistics in North America today, there's just massive multi-decade tailwinds and need for capital and expertise to be put to bear to build out critical infrastructure assets in those markets. And we find that very compelling at this point in time, kind of broadly across the North American market.
That's exciting. So thinking about, an investment strategy, everybody always looks at really two perspectives. Certainly what's the upside, but what our firm is far more focused on is downside protection and being very comfortable knowing that if we put a dollar out there, that we're going to get a dollar back and understanding that downside. So in your mind, what is the worst case scenario? How do things go wrong in the infrastructure world, knowing it has its own set of idiosyncratic risk factors?
Yeah, no, it's very fitting, both the moody skies outside behind me, and just the way the mantra effectively of our investment committee. It is absolutely focused on the downside case. I think 90% of the time plus that we spend in our committee discussions is, hey, what could go wrong, and then how could it go worse, and how do you protect against that? Fundamentally, I think infrastructure as an asset class, it really should be delivering defensive real returns to your portfolio. And if it is not, if the assets and the investment structure aren't robust and resilient to kind of all both macroeconomic conditions and idiosyncratic risk factors, then it's not doing its job. And that can go wrong, and it has gone wrong. But we really try to focus back in on true downside protected infrastructure investing. And similar to what you described, we almost flip the old adage on its head and say the best offense is a good defense. You win by not losing money, finding these defensive assets with strong underlying baseline cash flows, and then figuring out ways to deliver operational improvement, growth to the business plan on top of that. But if you're in distress, if you're struggling, you don't have time to kind of pull those upside levers. You're just trying to stay afloat. Look, that's an appropriate mindset, I think, and has really been put to the test over the last couple of years. We've obviously seen basically every macro stress test that a Federal Reserve bank stress test could dream up, and then some. We've seen whipsaws from sub 2% inflation persistently to double digits, from below 1% 10-year Treasury yields to over 5% or up to 5%. Last year, steady, if unexciting, GDP growth to one of the sharpest contractions in economic activity we've ever seen, and one of the quickest rebounds. And so I think we've seen, just really been through a roller coaster ride on the macro side. Beyond that kind of abstract macro view, though, we've also seen things like global supply chains upended through COVID, just like absolute restrictions on the movement of people, goods and services in a way we have not seen in our lifetime, or most of our lifetimes. We've seen outbreak of war in multiple regions globally, incredible volatility in energy markets, which affects obviously the energy infrastructure space, but also as an input to other energy intensive sectors that we look at or serve. Everything from incredibly spiking prices on the one hand to plummeting prices on the other, and scarcity of just absolute scarcity of supply in Europe and Asia. Imagine if you owned an airport through COVID, you saw literal throughput in airports go down by 95% at trough. And obviously there's been a recovery over time, but for owners of infrastructure assets, as with most other businesses in the economy, we've seen the true test of is your investment resilient to these massive shocks, and if so, it's proven the case that these assets are truly essential. They provide critical services. They have strong pricing power and sticky customers, and that's always what we focus on in our base case underwriting. And we've been, I think, not surprised, but pleasantly validated that our portfolio has stood up to that volatility and those stressors incredibly well the last couple of years.
Yeah, I think the last time I looked, you guys still had no realized losses in your portfolio. Is that still the case today?
That is the case, and again, that's the first, second, third, and final question of every investment committee is are we confident we can prosecute this investment over multiple years and eventually exit without losing money, and even if everything goes wrong. And so again, that's absolutely our focus when we're underwriting, and what we sweat every single day, operating and stewarding these assets. And we've been pleased to have been able to deliver on that so thus far to date.
Every business faces challenges. Every business faces what you might call headwinds. Let's maybe be a little bit more specific, take things from a bigger picture, macro level to like what's happening today that you guys see as risk factors specifically. You mentioned the North American strategy. You said that there's these three verticals you're focused on, and there's this multi-decade trend line, but it's not always coming up roses, right? There's things that are certainly fighting against it. What are some of those trends that are happening today that you need to deal with as a headwind?
Yeah, absolutely. Well, look, I mentioned inflation and interest rates, and those are big macro factors that affect businesses of all shapes and sizes. But I think we're looking for assets that are pretty protected against those. They have pricing power. They can pass through inflation. We're looking to be thoughtful and conservative on capital structure to be able to weather volatility in interest rates. I think a factor that's a little bit at times harder to control and often can make life difficult across all three of those sectors, and not just in North America on a global basis, but will be familiar to folks in this country and in every state basically, is the regulatory landscape, particularly with the ability to develop and build new infrastructure assets. These are large physical projects, oftentimes multi-billion dollars. They take sometimes years to build, and the construction period often feels like a blink of an eye when you actually look at the entire life cycle of bringing an asset to bear in terms of going through the permitting and licensing process. And so, that's not unique to any specific jurisdiction or sector. It affects all of them. NIMBY concerns are natural, and no one necessarily wants their backyard being dug up, but you do need to be able to work with regulators, work with politicians, and work with local communities to be able to figure out how to responsibly develop and build critical assets, or you'll see crumbling infrastructure or scarcity of everything from energy supply or pinch points in our digital networks, et cetera. And I think as much as there's been a focus in public policy discussion about the dollars that are required to go to infrastructure funding, and that's been persistent the last several administrations, and there's been progress on that front, bipartisan progress on the dollars element of it. I think the part that has been more challenging is streamlining the permitting and regulatory processes to allow things to be built. I think there's a lot of both public, again, capital, but especially private market capital that wants to expand these assets, build these assets out to power the economy. And many times the most difficult part is just that cycle of trying to get the permitting and the ability to kind of put that capital in the ground and create jobs and create the ability to deliver essential services to local economies.
Yeah, I wonder if that perhaps means that there's more or less opportunity for greenfield development or just acquisitions as part of that, right? Sort of oftentimes leaning into the complexity and the difficulty will yield, higher returns, but at the same time, if you can't get a project permitted, it doesn't really matter. So
no, it's a fantastic point. Like we are very good at building assets. It's not all that we do. It's not all greenfield. There's a lot of buying operating businesses and improving them. Oftentimes you're buying an operating business and building on that base. But you have to be really thoughtful about how you approach that risk, how you get visibility into the fallover risk of being able to deliver on a project. We do not take binary development risk across our sectors. That's a critical focus because it's just too hard to predict, and you don't want to put tens of millions of dollars into a project to get it to be shovel ready. Oftentimes takes a lot of time and a lot of money, only to not have a critical permit come through or to be litigated, have a project be litigated to death. So figuring out how to get into a project at the right time where it is ready to go, ready to build, or partner with existing businesses. And oftentimes it's easier to build onto an existing asset base or expand an existing business than it is to start from scratch. But how do we put incremental accretive capital to work without unduly putting ourselves at risk of being hung up for years and years and years? That's a critical part of how we think about accessing these sectors.
Yeah, that's a good point. Now let's turn that around and think about the tailwinds here. What's driving all this forward? And you mentioned that there were a few areas that you're focused on, and maybe if I can, I'd like
Sure.
to settle on the data center question because it's a big conversation today. NVIDIA stock is through the roof. Everyone's talking about AI, power chips, need for power, data centers, all of that, and if that's maybe not, one that you think is most important for investors to hear about, pick another one. But I'm personally curious around how are you guys viewing all of this rise of AI in an infrastructure lens, through an
Yeah,
infrastructure
no,
lens?
look, it's been a whirlwind. It's really such a new phenomenon, and something that was kind of on the horizon, and all of a sudden, boom, it's there. It's every day, basically all you read about, and it's certainly driving a lot of activity in the public markets. The pace of change is mind-boggling, and I think if we were trying to underwrite where does this technology go, and what do the cash flow stream look like for a software business, or even a chip manufacturer in 5 years, I would struggle to do it. So smarter people than me could figure it out, but I think we would struggle to do it. I think critically for us, we don't have to pick the technology winners and losers. We don't have to figure out exactly what end use is going to have the most viability from a business plan perspective over time. All of it is so data hungry, and so you mentioned power capacity hungry, that we know what that looks like. We know that that's significant upside, and it's pretty striking. I come from a power utilities background before Stonepeak. Power demand in the U.S. has been flat for a very long time, flat to declining, depending on the region. As we do probably a little bit less industrial heavy of an economy, more energy efficient with the things that we do economically to power our economy. It's more technology and software driven. You've seen declines in power intensity of any given unit of GDP. That has just flipped on its head the last 12 to 24 months, and is now projected to grow significantly. Some of that is obviously electrification of transport and the like, but a lot of that is just the incredible appetite from the technology companies and the data center capacity that they need to power these large language models, on top of what was already exponential growth in data center demand baseline before you even factor in generative AI. So it's a pretty interesting trend, and honestly, one of the biggest pinch points, we think, in deploying AI across all of these different potential use cases that you could imagine, and many I'm sure that we can't today, is just the fundamental physical assets that support that, the data center, and then the interconnection to the grid, and the power generation capacity to support those data centers. All of that kind of downstream of the actual technology itself is where we play, and there's just trillions of dollars of investment opportunity to support that in the near to medium term.
Let's maybe take a step deeper in, and you guys being infrastructure specialists are going to have insights that a lot of people are not. So what do you think is a factor, maybe continuing with the data center play, or another sector that you're looking at, that would surprise people, that there's either a hidden risk factor associated with that, or a hidden call option that you feel like you're getting very cheaply or for free, that most people are just not going to be aware of because they don't live in it every day like you guys do?
Yeah. No, look, I think one of the surprising things when you really dig in is just recognizing again all of the ways to play these trends that are less obvious. Infrastructure, we can take it for granted what actually is infrastructure, and how do things work, and you just kind of you don't ask yourself that question that often. But again, if you think about AI and that trend, we talked about the data center element of that. But another element of that is chip manufacturing itself, and you talked about NVIDIA, but certainly the other chip manufacturers trying to tether themselves to that long-term demand tailwind as well. We're not going to go obviously buy their public stocks. We're not going to go buy a chip manufacturer, but they are consumers. They are huge consumers of very specific inputs to make that process work. It's massively complex. A chip fabrication facility. You see the numbers in the CHIPS Act to subsidize some of these new facilities. A fab is $10-20 billion a piece of capital investment into that fabrication facility. They need to work perfectly every hour of the day without fail, and so that's going to be power that they're consuming. That's also specialty chemicals and inputs to that manufacturing process. And so one of the things we looked at that and said, how can we play that? And particularly also the geopolitical focus on reshoring American manufacturing of chips. How can we benefit from that or support that with our dollars and expertise? And so we were able to go out and identify the leading specialty logistics player that serves Intel and several of the other big chip manufacturers. And the handling and distribution of specialty chemicals and the doing of that with precision, security, on time, exactly where it needs to be, when it needs to be, it's a small proportion of what chip manufacturing cost base looks like. So they're a little bit, maybe less sensitive to that as an input, but it's got to be right, or else the rest of the operation fails. So I think there's being in the weeds in each of these sectors, you have the ability to identify these second or third derivative plays that have very steady, stable demand that are tethered to these long-term secular tailwinds like AI or chip manufacturing or reshoring of industrial activity, but have just very steady, under the radar sets of cash flows with long-term growth trajectories that we think are really attractive.
So let's try to take all of that and distill it down into a number. We like to ask this question of our partners like you all on a scale of 1 to 7, 7 being the best, 1 being the worst. How would you rate the risk reward in your area today?
Yeah, look, I think the overall risk reward's in a 5 to 6 range. I think, like I said, it's very rare that there are these long-term mega trends behind, digitization of huge swaths of our economy and the need for data centers, fiber, cell towers, small cells, et cetera. The need to transition our kind of entire energy supply chain to be both secure, affordable, abundant, and lower carbon intensity over time, and then the nearshoring and reworking of our supply chain. So to have all of those at the same time is incredibly attractive. That said, there are macro headwinds, inflation and interest rates that we have to be thoughtful about how we play that. It's not every opportunity is going to be attractive. It's finding the right ones within those mega trends that are going to give the right risk return. So we're very bullish on the opportunity set, but we do think it's incumbent on us to navigate some of those bigger macro headwinds to find the specific opportunities that are most resilient with the greatest upside that we can access.
All right, let's wrap up with this question, which is looking at how to express your strategy, investing in infrastructure in the public markets, and the options that are available there, and maybe list, you don't have to name specific stocks, but different strategies that exist publicly versus giving money to, Stonepeak in your next, North American infrastructure fund. Why is doing it with you all, your strategy, your execution better than doing it, investors sort of going their own way in the public markets?
Yeah. Look, we interact with the public markets frequently in that, there are large strategics in each of our sectors that we look to buy assets from, we look to partner with, we look to provide capital to. I think the interesting thing is we can take the alignment model of a private capital approach to these sectors. This is, these are assets with 20, 30, 40-year useful lives, and so the ability to think about where is there a need to put capital? How can we stay disciplined about those capital investment cycles over long periods of time, not having to think about driving a quarterly revenue growth number, which arguably, the public players shouldn't be worried about, but that's how public markets work. They are very focused on near-term results. And what we've seen over time is that leads to boom bust cycles of, in cheaper capital environments, people putting capital to work at not necessarily true attractive return on invested capital or return on assets, but trying to show growth for growth's sake. That's the time where we can be patient, we can step away. In fact, we can sell assets into that market for attractive exits. And then when you see capital markets reverse, valuations come down, the access to cheap capital in public equity and debt markets be a lot more dear, we can be a great partner to those public players, and or we can buy assets from them. And so I think we're just able to be almost counter-cyclical to that boom bust cycle in the public markets, more patient and disciplined about fundamentally what is the return on capital what is the resiliency of the returns we're going to generate cash on cash for the capital we're putting in the ground. And I think that patience and disciplined long-term approach often gets, not always, but often gets lost in kind of the volatility of public markets.
Yeah, I hope what everyone's hearing from Dan here is, and consistent with a lot of the other folks that we've had come speak to in this format, is that there's a prudence, there's a discipline, is a word that you just used. There's a measured approach that is very valuable when you're looking at things over a long horizon. Infrastructure certainly is that. Well, Dan, this has been great. Thank you, my friend. I appreciate you carving some time off here to educate our investors and to share with us. So on behalf of everyone here at CAZ and our whole ecosystem, thank you, and we wish everyone a great day.
Fantastic. Appreciate the opportunity. Thank you.